Hi, this is Dr. Tom Gerard, and this is a first chapter in financial accounting. And I want to make this quick video for people who are taking accounting for the very first time, and this is very first chapter. Now, I'm using material from Cengage. That is one of the big publishers of accounting textbooks and stuff. And there are others, but they pretty much follow the same format. I wanted to let you know that this is not a class for people who are chief financial officers or controllers or people who've been long-term accountants and understand all this. This is for an introductory student who maybe this is your very first time being exposed to this material. And so when you start the chapter 1, it kind of goes over a whole bunch of stuff. It throws tons of information at you, especially for those of you who have never been exposed to this stuff. But let's take a look and see what we're going to cover here. Now, what you'll see in most of your books is when they start off, they're going to give you learning objectives for this particular chapter. So it says here, and now there's a lot of them, like I said, in the first several chapters in the book. As you go through the material, you'll get into more specific things. But this is a general overview, so it's a lot of information for people, like I said, that are brand new. So first of all, we have the role of accounting in business. Generally accepted accounting principles. That's GAAP is abbreviated GAAP. So you hear people say GAAP, GAAP, and that's what we're going to use in this course. Underlying assumptions and principles, and there's quite a few of those, and they go through that in chapter 1. Accounting equation. Now, the accounting equation is the heartbeat of all of accounting, and as we go forward through the first several chapters, we're going to get into that in great detail, but it's an introduction right off the bat here in first chapter. Describe and illustrate how businesses transact things. Now that's just the first slide, so we still have a lot of objectives here in this particular beginning chapter, like I said. So the next thing they're going to talk about is financial statements. Again, so you're learning GAAP, you're learning principles and assumptions, you're learning financial statements, you're learning types of businesses, and then at the end they even throw in a financial ratio. And in most courses, they'll introduce a financial ratio, and if you don't know what that even means, don't worry about it right now, but you'll get exposed to ratios in every chapter, and then between financial accounting and managerial accounting, they'll have a whole chapter on analyzing financial statements, and that's where you look at many different ratios kind of combined all in one chapter. So this is kind of a precursor whenever you see these first ratios in each chapter. Okay, so let's just go through this really quick. Nature of business and accounting. You can, read your book about that. Types of businesses. Most of you know different types of businesses that you've been exposed to. Again, in accounting, remember when we're talking about from an accountant standpoint, you really look at things a little bit differently than the average person does. And so you just kind of get used to that as you go on, and there'll be some more specific examples of that as we continue. So types of businesses, the role of accounting in business. I'm not going to go through all of this because most of this is straightforward. One of the things that you want to do in anything you're doing in business is, number one, identify who is this for? Who is this information for? If you take marketing, it's like, who's your target customer? And accounting is, we're doing all this work on all these financial statements and maybe a lot of analysis and numbers crunching and things of that nature that we all think of when we think of accounting. But the question is who are we doing it for? Because who we're doing it for determines what it is that we need to provide and how we're going to do it. And that's kind of what this is about here. Talks about a little bit about managerial accounting and financial accounting and the difference between the two. I do a whole video on that because it comes back to this question: who is it for? Is it for, when you say managerial accounting, is that it's for management, right? The information is for management. When you say financial accounting, we're talking about preparing the financial statements. And the financial statements is for both people inside the company and what they call internal users and external users. And so we'll see that as we go. But again, I have a whole video I do on the differences between financial and managerial accounting, especially when you move from financial to managerial. That's really where we cover that more in depth. Role of ethics in business, 4 slides on this. It talks a lot about some scandals that went on. Again, I would do videos on all of this independently. Right now, I'm trying to just give you an overview of what's in chapter 1. Ethics. So how do we prevent some of these scandals? Training in ethics is required if you're going to be certified in any kind of accountant. And that continues. Let's go on. Opportunities for accountants. Now, I love to show, videos and all of this stuff when I'm teaching a class on campus about the opportunities. Now, there's a lot of opportunities. Now, first of all, I'm a little prejudiced, obviously, because I've worked in accounting most of my life, well, at least in the last 20 years. But there's always going to be accountants. Things become automated with software and artificial intelligence and all these kinds of things. But all of those softwares and artificial intelligence is only as good as the people that are putting in the information or programming it and setting it up. And as you go higher up in accounting, you realize that people make mistakes, the software makes mistakes, and to figure out what's going on is very important, especially when we're talking about the financial part of a business. You need to have accurate information, and many times the information is not accurate because of the people that are putting it in or the software that's being used. And so you learn about the opportunity that, and now of course it talks about some different things. In fact, even in this book, it tells you some different salaries. This is, again, a textbook that's a national textbook or worldwide textbook. Most of your big corporate companies that place accountants in jobs, like Robert Half, they publish an annual report of all the different jobs in accounting and how much people make at these different jobs. And they vary greatly depending on where you're at. And they actually have a supplement. So like I happen to be in the Tulsa, Oklahoma area. So you'll have a book from Robert Half. Every year it comes out, all the different jobs, how much they pay, and maybe what the requirements. But then they'll have a supplemental for your particular area, wherever it is that you happen to reside, to change the salaries. Now, again, this is very subjective even within particular areas, because some people, depending on the industry, it has a lot to do with the industry too, because accounting, as we see as we go through this whole journey through this financial accounting book, you'll see that there's many different areas of accounting. And quite frankly, every chapter after we get past about chapter 3 or 4, or after chapter 4, I think, in this book, is different. Every chapter is a different job. And within that particular area, say payroll, for example, you're going to have different people doing different specific jobs. So there's a tremendous amount of opportunity, because the person that keeps track of the numbers and the financials of financial things of a company is really one of the most valuable people that companies have. Okay, even now here it talks about GAAP, generally accepted accounting principles. Now, I typically like to talk about different business entities, which is also covered in chapter 1, before I introduce GAAP personally. And the reason is because generally accepted accounting principles is required if you're a for-profit publicly traded corporation. And you'll hear me use that a lot. If you hear me speaking, you'll hear me say, it's a lot of words, right? For-profit publicly traded corporation, because the rules for them are much more stringent, and they have to follow GAAP. That's mandatory that they follow GAAP. If you're a small business, I just started selling stuff on Facebook Marketplace or eBay or Etsy or Shopify, these kinds of things, or anywhere. You could be a sole proprietor and maybe not have to follow all the specific rules that GAAP says you do. But it's always a good idea. I recommend, personally, when I counsel small business owners, I tell them follow GAAP, even if you are a small business. And the reason is because this is going to give you accurate information. The whole point of this is to have transparency and accurate information. And there's nothing more valuable to a business owner or a person running a business at any level within a business than having accurate, timely financial information. And again, like I said, that's why there's always going to be opportunities for accountants, because they're the ones that provide all this. Now they're going to talk about some government agencies to set this up. And then now we're going to start talking about characteristics of financial information. And you can go through all of this. And again, I could get into great detail on every one of these topics. I really don't want to spend too awful much time because we got a lot to cover. Now we're talking about assumptions of accounting. These are all important. I could do a more thorough video on every one of these topics that we're going to go through, but this is really an overview. Assumptions, forms of business entity. Now this is where I wanted to get, because most of your books will introduce this before they talk about GAAP and accounting assumptions, because like I said, they're a little bit different. But they almost always introduce you to forms of business entities in Chapter 1. If you have had other business courses, you may already know all this, and that's okay. But for those of you who don't, this is really talking about, if I set up a business, how is my business set up? And the first one you'll see here is what they're calling a proprietorship, owned by one individual. Again, I sell stuff on eBay, I got a Shopify, or I'm selling something at, in the old days we would say the swap meet or the auction or something like that. You're in business, right? According to the IRS, if you're taking money in and making sales, or you're providing a service, maybe I mow lawns for people. And I love that example because I use it quite a bit when I'm teaching accounting, because it's very basic. Everybody can kind of get their head around it, and it's a really good example. But you're providing a service and you're being paid for it, right? So you're in business, you're a proprietor. And again, it says here, 70% of businesses in the United States are a sole proprietor. So most of your small, what we call mom and pop businesses, still fall into this. I would recommend them not to, but they do. A partnership, now this is where two or more individuals, it's very much like a proprietorship, except for maybe you're a partner with somebody. And again, I personally, that says 10% of businesses fall into this category. Although it says combined with limited liability company, which is one of the other entities. Now you can get in, again, you can read more in depth about these, but these are two, and then we got two more that they talk about. The other one is the limited liability company. Much like a partnership, only you're much better protected. I recommend for anybody that's going to start a business or be in business that you graduate from sole proprietor or partnership to limited liability ASAP right away, because there's so many benefits to it. It protects you from a lot of things. And so in my state, it's $125 to set up a LLC. Go on the website, pay the money, and fill out some forms, and you're a limited liability company. Now, of course, there's more follow-up to it than that, but it's not costly to do this, and it is so well worth it, to be honest with you. Now, corporations, this is the big one. So we think about businesses we all know, Microsoft, Apple, Google. These are corporations, and those are what we call, like I said, for-profit, publicly traded corporations. Now, there are corporations who are not publicly traded, meaning that they're all owned by a person. You could be instead of being a limited liability company, maybe you're a dentist, maybe you're an architect, and you are a corporation. You can form a corporation and just be one person, and or you can be a corporation like I said, like Walmart or something, that's owned by hundreds of thousands of people. If you own one share in the stock, you're technically an owner of that company. So So most of what we talk about in this class, why this is important, is related to corporations. Like I said, the GAAP, corporations have to follow the GAAP procedures. However, again, whether you're a limited liability company or even a sole proprietor, I recommend following the GAAP procedures because it's more beneficial to you as a business owner or a company for knowing your information. Okay, let's continue. And now these are more assumptions, principles. I won't go through all these here. Now, next thing our big thing that we talk about in chapter 1 is the accounting equation. And so when you think about the accounting equation, you think, oh my gosh, an equation? I don't know anything about math. Well, don't worry about it. One of the biggest things is understanding these terms, right? Because now accountants, we call accounting is the language of business. And what we see right away is that we've got some new words we've never been exposed to. And maybe you have, or maybe you've heard them and they're used in a different way than the way accountants use them. So the first word, of course, is assets. So it says here, resources owned by a business is called assets. Many people, if you've never taken accounting, you might use the word assets referring to some other stuff. But in a business, it's resources, and resources is a broad term, and we get really more in depth as we go through on what does this mean? What does resources mean? What about liabilities? Now this says the rights of creditors and the debts of the business. So real briefly is if I owe somebody something, right? I owe them money, or maybe I owe them my service. If I'm a service provider and somebody has paid me, I owe them the service, right? Maybe most of you pay on a subscription basis for some type of television service or your Spotify or something of that nature. Then to those companies, if I'm paying on a monthly basis, many companies pre-bill, meaning that I'm paying for the month in advance. Maybe your healthcare, you're paying for the month coming up. So they owe you the service because I paid for it, right? So that's a liability. And again, we'll go into each one of these in depth. The rights of the owners is called equity. Now, this is, again, another term that gets confused because it's used a lot in real estate. We're like, how much equity do you have in your house? And we can use that analogy, but it's more than just that, right? It's more than that. If I buy one share, like I told you a minute ago, if I buy one share of Walmart, I am an owner of Walmart, and technically I have equity in Walmart, right? I have a piece of it. And so it's like, wow, you mean you own Walmart? Well, yeah, I own Amazon too, and Google and some others, right? Tesla, or whatever the one that you want to think is the hot stock of the day. Go out and buy one share, and you have equity in the company, and you are an owner of that corporation. Very small one, but still. So owners is the rights of the owners, right? Okay, and then it goes on. It talks about stockholders' equity. So we have a stockholders' equity, meaning the people who hold the stock, just like I said, right? And then there's owner's equity. Proprietorship, partnership, limited liability is owner's equity. So these words are used in different accounting books depending on how you're being taught. It will say owner's equity or shareholder, stockholder, shareholder, same word. Interchangeably, however, we're primarily going to be concerned in this course with stockholders' equity because we're talking about a corporation, right? Now, remember, if I'm a dentist and I'm a corporation and it's just me, I am a shareholder and I hold 100% of the shares. It's all mine, 100%. Whereas, like I said, Walmart is divided up between maybe hundreds of thousands of more people. Okay, that's the accounting equation. Here's how it works. Assets equals liabilities plus stockholders' equity. We'll get really heavy into this in chapter 2 to understand that. And that I will continue now because I got to cover one more thing before we're done with this video. And then they talk about the transactions. I'm going to skip through all this for now. I do more in-depth videos on all of this. But at the end of the day, our goal that we're trying to get at, if I can find my slide here, is to get these financial statements prepared. Now, these are financial statements for, I'm trying to get my picture where you can see it. These are financial statements for a company, a corporation. It doesn't necessarily have, like I said, if you follow GAAP, it could be for your business as well. You know, a proprietorship, limited liability company, etc. So there are 4 main financial statements. And the goal of chapters 1 through 4 in this particular book is to get through these, right? And so this is where I have to say, you know, you're going to be bogged down with a lot of new stuff, a lot of heavy learning in this first several chapters. And at the end of these several chapters, the goal is to be able to build these financial statements according to GAAP. And that is a lot for 4 chapters, right? In your book, depending on if you're using a different book, could be 3 chapters. It's a lot to absorb, especially if you're brand new to this. So let's talk about these real quickly. We got the income statement. Now let me just say this so you understand. And again, I tried to teach this as though you've never had any exposure to this at all. Brand new. So think about you're going to start a business, and this is where I say, when I do a talk on this, where small business owners, think about a small business owner that have never taken a college class. They know nothing except for, I'm going to go out and work. Again, the way people have done things for thousands of years, right? So first of all, most people understand the income statement. They go out, I'm going to buy something, and I'm going to turn around and sell it for more than what I paid for it. Simple. That's, if I make money, I have income. So now you will hear a lot of people, and especially in the older times, I guess you might say, they would call this the P&L, or profit and loss statement. So that, and you'll still hear a lot of people use P&L. Well, P&L is profit or loss, right? So if I buy something and I sell it for more than what I, paid for it, I got a profit. If for some reason I buy something and I can't sell it for more than what I paid for it, or maybe it costs me money to transport it or ship it, or I have to do work, I have to hire somebody, and there's other expenses that goes into it, I could have a loss. So really almost everybody that goes into business, even on a very small level, understands income statement, right? And again, we'll talk about this more in depth as we go. Statement. Now let's go to the balance sheet. The next thing we want to talk about is balance sheet. So the balance sheet is this accounting equation that we just saw: assets, liabilities, and equity. Okay. Now again, owner's equity, stockholders' equity, equity assets equals liabilities plus equity. That's the accounting equation, and it's on the balance sheet. Now again, think of a small business person. And I always like to use very simple examples to show you that what we're talking about, not only applies to big corporations like Apple, but it also applies to small businesses. So I'm going to go out, and I like my lawn mowing business because it's something that, depending on where you live, people mow lawn all year long, or maybe they only mow it several months out of the year, or maybe not at all, I don't know. But you get your idea that I'm going to provide a service. But before I can go out and start mowing lawns, I got to have a lawnmower, right? So my balance sheet is going to have my asset. Remember, it's something that's owned by the business. So I've got to go out and I got to get a lawnmower. Now, if I'm going to be mowing lawns for a business, and I'm going to be mowing lawns all day long, hopefully, then I really need a good lawnmower. I can't just go get one at a garage sale, and hope it's going to work. I have to get maybe a $10,000 or more zero turn. That takes a lot of money, which means I have to go out and borrow money from somebody, because I don't have $10,000 to buy a $10,000 lawnmower. Or if I do have $10,000, I'm using it for some other stuff, right? Working capital, they call that. So what I do now is I got to go borrow money, and that's a liability, right? Remember we said that? What do I owe to my creditors? So I borrowed $10,000 to buy a lawnmower. I owe this $10,000 to the bank. That's a liability. Now I have an asset, a lawnmower, and I have a liability, right? So remember, we're in balance here, see? So think about the balance sheet. We're in balance because I have a $10,000 lawnmower and I have a $10,000 loan. Now let's just say that the bank says, well, we're not going to loan you $10,000. We're only going to loan you $8,000 because you have to put in 20%. You have to put in $2,000 of your own. So if I put in $2,000 of my own money, right? Now I have a $10,000 lawnmower, assets equals liability of $8,000 I owe to the bank, and $2,000 of my money, my equity, right? So my equity in the business. So remember, liability $8,000 plus $2,000 that I put into my money, equity, that equals the $10,000 lawnmower. Okay, so that's your balance sheet. Again, don't have to be a sophisticated CFO to understand that. Most people can grasp that. Then the next thing, so you'll see this is statement of stockholders' equity. That's telling me that I have $2,000 worth of equity now in this business, right? Because I put $2,000 of my money into it to get this lawnmower. But my goal of mowing lawns is to make money, right? So my goal is to go out and mow lawns and increase my equity. So what am I going to do? Somebody's going to pay me cash, which we're going to talk about here in just a second, to mow their lawn. And the cash is a asset, right? It's something that the company owns. So think of cash as something that belongs to the company. And again, we can get real confused about the terminology on some of this, but say I go out and I mow a lawn and I'm going to use round numbers. Maybe you don't charge as much or maybe you charge more. I don't know. But let's just say it's $100 for the sake of our experiment here, our example. So I bought my lawnmower. I put in my $2,000. I got an $8,000 loan, and now I go mow a lawn for $100. Now what? And the person pays me, first of all. I'm going to make sure we understand the person's going to pay me cash. So I got $100 now that goes into the business. And what is my assets? My assets is a $10,000 lawnmower and $100 in cash. On my other side, right, my equity now has gone up. It's gone up by 100 because now that extra money is my equity, right? So that is going to show it, and let's pretend now I did all this, and I don't know if you mow lawns on December 31st, but let's just say your year ends on the 31st of December, and New Year's Eve you're out mowing a lawn, and at the end of the day, I got the $100 and I'm done now because that's all I did for this whole year. Then my change in my equity was $2,000 I started with because I put that in, and then I actually added $100. See, summary of changes in stockholders' equity that have occurred during a specific period of time. Okay, so that's what that is. So now my new equity statement says 2001, right? Statement of cash flow. Now this is the one that really gets small business owners. I know it's a 30-minute video. I think I should do a whole video on statement of cash flow because it's one of the most misunderstood ones by small business owners. Most of this stuff I've covered, people can understand. Oh, I got to buy some lawnmower. I got to put $2,000 of my money in. I got to borrow some money, and I got to go out and mow some lawns to make money. That's your income statement, right? But the cash flow is where it really falls apart, and this is where small business people get lost. And according to the Small Business Administration, and it has been confirmed later by surveys with the Entrepreneur magazine, the number one reason why so many small businesses fail is because of cash flow problems, cash flow. And they can be making a lot of money on income statement and really losing cash. So that's what we're going to talk about at another time under statement of cash flow. But understand that this is telling you how much cash is coming and going out of your business, right? So cash comes in because I mowed a lawn, but cash also came in from the bank because the banker gave me $8,000 to go buy a lawnmower. So I have money coming into the business, and I also put $2,000 of my money, right? So this cash came into the business. Okay, let me review that one more time real quick. So cash comes into the business because I put $2,000 of my money in. The banker put in $8,000 in cash. And I also got $100 for mowing a lawn, right? So I got 3 different ways that cash came into the business. And then I have, how did cash go out? Well, I bought the lawnmower, right? So I put $10,000 out for the lawnmower. But let's just assume all things with just my little example so far, that's it, right? Cash went out, 10,000, and cash had come in. $10,100, right? Okay, so here we go. And then it talks about that. So that's all I want to cover really here for the information. Now, there's a lot more of this in this chapter, but I wanted to give you a really quick jump into chapter 1. There's a lot of information. Don't get discouraged. Take your time with chapter 1 and 2. Please take your time with chapter 1 and 2. Going forward, I always hate to use the word it gets better or it gets easier, because for some people it seems like it never does. There are some chapters that are pretty rough in the financial accounting, but chapter 1 and 2, especially if you're brand new and this is all new to you, can be quite challenging. So stick with it. You can do it, and we'll see you again in the next video. Hi, this is Dr. Tom Gerard again, and I wanted to thank you for watching my video. I'm looking at doing an entire college course in financial accounting on video. So if you want me to do that, please put it in the comments. Again, there's lots of videos on YouTube about accounting and the principles of different things in accounting, but I want to put it together just like as if you were going through it in a college class. And this, especially if you're a college student, this would really help you to be able to get through your material. And I actually just apply some of the stuff you're learning into your real life situations. So anyway, please subscribe to my channel and put it in the comments that maybe you want to have access to the college course in accounting.